Welcome back to this deep dive into the fluctuating realm of finance and economics. Over the past few weeks, numerous headlines have stoked widespread concern over the U.S. economy's health and future prospects, revealing a complicated tapestry of factors that have combined to create a sense of anxiety among consumers, policymakers, and investors alike. While the economic picture has been uncertain for some time, the latest flurry of data, ranging from gross domestic product (GDP) projections to consumer spending trends, has triggered alarms that the world's largest economy might be barreling toward a downturn sooner than anyone anticipated. At the heart of this narrative lies the stark realization that American consumers, historically seen as the backbone of U.S. growth, appear to be running out of disposable funds and coping with increasing debt burdens. Meanwhile, President Donald Trump's new reciprocal tariff plan promises to shake up global trade in ways that could exacerbate domestic vulnerabilities, or, as the administration hopes, spark a resurgence in domestic manufacturing. That said, critics worry the new policy might be an ill-timed move, arriving just as financial fragility becomes more glaring than ever. In simpler terms, an economy signals trouble when growth starts sputtering, confidence wanes, and consumer credit usage spikes for necessities instead of discretionary spending. Over the past quarter, a growing chorus of economists have slashed U.S. GDP forecasts. The Federal Reserve Bank of Atlanta's so-called GDP Now tool has shown negative growth predictions, sending a wave of apprehension through trading floors, newsrooms, and living rooms across the nation. While these estimates can shift at a moment's notice, the underlying data, declining retail figures, weakened consumer sentiment, and stagnating incomes, tells a consistent story. Households appear tapped out, with savings depleted from earlier stimulus packages and real wages failing to keep pace with elevated costs of living. When Americans rein in their spending, it undercuts a fundamental engine of the country's economic machine. Yet the gloom extends beyond consumer caution. At the same time these signals flash red, the Trump administration has unveiled a highly ambitious reciprocal tariff regime aimed at roughly 60 foreign markets. The plan, pitched as a quest to make America wealthy again, attempts to mirror or partially offset tariffs and alleged trade barriers that the White House believes have disadvantaged U.S. goods for years. Each targeted country, from large economies such as China to smaller ones like Sri Lanka, faces a custom tariff rate set at around half the rate that officials in Washington estimate these nations impose on American imports. Although such policies have existed in different forms over past decades, the sheer scale and timing of this push have raised eyebrows globally. By launching it when domestic consumer strength already appears fragile, the administration risks hiking prices on everyday imported items, just as people's wallets are stretched to breaking point. Rather than spurring a domestic manufacturing boom, skeptics suggest the strategy could weigh even further on household budgets and hamper growth. Meanwhile, the Federal Reserve, tasked with walking a precarious line between containing inflation and avoiding a recession, faces a particularly vexing challenge. If tariffs drive costs upward, the inflationary spike could push the Fed to tighten monetary policy, thus risking more strain on growth. Conversely, if overall demand plummets and the economy slides into a downturn, easing might be necessary. Critics say the timing of these measures, introduced when both consumer liquidity and business confidence teeter, essentially pours uncertainty into an already muddled outlook. In short, the seeds are planted for significant volatility in financial markets, and those seeking stable investment returns will need to stay attuned to rapid shifts in consumer spending, tariff announcements, and Federal Reserve commentary. By the end of this exploration, we will examine the mounting evidence that the U.S. economy is flashing warning signals, clarify the details of Trump's reciprocal tariff policy, consider the Federal Reserve's predicament, and discuss some best practices for individual investors. After all, the crux of financial survival rests on how effectively one can navigate a roiling environment. As you read, keep in mind that staying informed, disciplined, and calm can help weather the storm, no matter how chaotic the surface of the market seems. To set the stage, we must first look squarely at the signs of distress emanating from various corners of the U.S. economy. For much of the prior year, economists debated the prospects of recession versus continued expansion, often pointing to mixed signals in employment, manufacturing, and consumer data. But as 2025 has progressed, the picture has grown distinctly bleaker. Foremost among the concerns is real GDP growth. The Federal Reserve Bank of Atlanta's GDP Now model sent shockwaves when it signaled the possibility of negative first quarter growth, potentially around minus 1.4%. Although that figure was initially disputed by analysts who attempted to explain away the shortfall due to peculiar spikes in gold imports and other anomalies, subsequent adjustments confirmed that even after stripping out those factors, the model's outlook remained negative or stagnantly close to zero. Critics rightly point out that forecasting tools are never perfect, but the downward trend they reveal is difficult to deny. Other major banks on Wall Street have similarly revised their projections down to near zero or even slightly below, underscoring a broader consensus that momentum is fading. This souring environment dovetails with weaker consumer metrics. Retail sales have dipped for 2 consecutive months. Confidence surveys show a deep plunge in optimism, and credit card debt has soared. Households seem to be facing acute financial stress, which has appeared in rising delinquencies on mortgages, auto loans, and credit cards. In many cases, middle and lower income families have exhausted the savings they'd built up earlier in the economic cycle, especially funds accrued during massive stimulus programs. Put simply, a consumer who lacks disposable income cannot propel growth. Why has consumer spending deteriorated so dramatically? Several factors converge here. First, wage growth has not kept pace with inflation, meaning real purchasing power has eroded. Over the past decade, certain cost of living pressures, ranging from rent to healthcare, have outstripped wage gains. Even if nominal earnings rose, the higher base prices eroded the net effect. Second, federal stimulus measures, once a pillar supporting households, have tapered off. While these programs bolstered spending in the aftermath of shocks like the pandemic, they were not permanent, leaving individuals dependent on a job market that, although it boasts a low unemployment rate, does not always provide robust wage increases. Third, many households appear tapped out on credit. With interest rates gradually moving upward after years of historic lows, borrowing is more expensive, and revolving debt on credit cards becomes burdensome. This perfect storm results in a collective belt-tightening that in turn weighs heavily on GDP growth. These developments alone would generate concern, but the timing of Trump's new tariffs adds another layer of complexity. For decades, American consumers benefited from relatively inexpensive imports: electronics, clothing, automotive parts, and countless daily necessities. By introducing wide-ranging tariffs to match perceived foreign barriers, the administration could unintentionally spur price hikes across multiple consumer categories. While the administration insists the new policy might eventually encourage domestic production and lower final prices in the long run, the near-term effect could easily be inflationary for everyday goods. For families already struggling to pay bills, higher price tags could become the straw that breaks the camel's back. All these warning signs paint a precarious portrait of a consumer-driven economy teetering on the edge. Even if job postings remain relatively high and certain industries show resilience, the underlying weakness is troubling. As consumer sentiment erodes, the economy can lurch into contraction quicker than many expect. If that scenario materializes, it may leave policymakers scrambling to contain fallout. In that sense, the data strongly suggests that the final outcomes of 2025's first 2 quarters hinge significantly on how swiftly household finances can stabilize, or whether new policies, such as the tariff initiative, inadvertently accelerate the slide. From here, we turn to examine the specifics of Trump's reciprocal tariff plan and how it might compound existing risks. President Trump's reciprocal tariff plan, announced in the midst of economic uncertainty, is both ambitious and controversial. The administration paints it as a fair-minded strategy to equalize trade terms by imposing new duties on countries that allegedly penalize U.S. exports. When unveiling the plan, Trump described it as a key step toward making America wealthy again, framing it as a tool to bring factories and jobs back to U.S. soil. The logic is simple on paper. If China, Vietnam, or Sri Lanka are perceived to charge high duties on American goods, then the U.S. would impose roughly half that rate on their imports. For instance, should Washington conclude that Vietnam levies a 90% overall effective tariff, then the U.S. might retaliate with a 46% tariff on Vietnamese imports. Advocates call it a bold stroke against years of trade imbalances, insisting that other nations have erected barriers for too long while enjoying easy entry into American markets. However, the calculations behind these proposed rates are anything but transparent. The administration's estimates rely on a mix of official tariff schedules, alleged currency manipulation, and intangible non-tariff barriers. Critics argue that Washington's methodology is prone to exaggeration, or at minimum, open to interpretation. If the U.S. sets these reciprocal tariffs too high, they risk incurring retaliation from multiple partners simultaneously. Such an outcome could generate a domino effect across global supply chains, pushing up costs and restricting market access. Furthermore, many U.S. multinationals rely on complex cross-border networks for components and final assembly, meaning sudden tariff spikes can disrupt operations and drive up expenses. In that scenario, consumer prices might rise even more sharply, negating any potential savings from scaling up domestic production, at least in the short to medium term. The question then is whether this policy can actually make America wealthy again, or if it will backfire by hammering household budgets and chilling investment. Historically, tariffs function like a tax on imported goods, which businesses either absorb or pass on to customers. In a high inflation environment, additional price pressures are rarely welcome. Opponents of Trump's plan warn that the policy might further damage an economy that shows signs of faltering consumer spending. After all, placing large duties on electronics, clothing, and auto parts, staples in many Americans' daily lives, could trigger an abrupt price hike. That, in turn, may worsen the financial squeeze that consumers are already feeling, potentially accelerating a slowdown. Another point of contention concerns government revenue. Optimistic forecasts from the White House peg potential tariff inflows at hundreds of billions of dollars, money that could theoretically offset budget deficits or fund domestic priorities. Skeptics counter that such estimates are overly rosy. They point to past experiences in which high tariffs led to decreased import volumes, rendering final revenue figures much lower than projected. Moreover, if the federal government is concurrently pushing for significant tax cuts on income or corporate profits, the net effect on the deficit might remain unchanged or even become more negative. All the while, Washington's posture has heightened tensions with trade partners who vow reciprocal measures of their own. The result, some fear, could be a full-blown global trade conflict with multiple countries retaliating in kind. Such tit-for-tat tariff wars have historically proven damaging for all parties, sometimes leading to global recessions. Although a portion of American manufacturing could, in theory, stand to benefit, especially if companies relocate production stateside, real-world adjustments often lag behind policy announcements. Firms do not instantly build factories overnight. Supply chains do not seamlessly realign. Thus, the near-term disruptions could overshadow potential long-term gains. Given the precarious status of the U.S. economy, the burden of balancing these new trade moves with monetary stability now falls heavily upon the Federal Reserve. The Fed must reckon with inflationary pressures arising from tariffs while also confronting a very real possibility of a recession if consumption continues to dwindle. It is against this backdrop of slowing growth surging consumer debt, and fresh tariff announcements that we must consider the Federal Reserve's predicament. The Fed, mandated to maintain price stability and foster maximum employment, faces a dilemma that economists refer to as a policy trap. On one hand, rising tariffs could nudge inflation higher, forcing the Fed to contemplate further rate hikes or at least delay any rate cuts. On the other hand, new data suggests the economy is moving toward a stall, rendering restrictive monetary policy a potential catalyst for a deeper downturn. Each pathway presents risks, and choosing incorrectly could worsen either inflation or recessionary pressures. To appreciate the tightrope the Fed walks, one need look no further than how inflation has behaved in recent years. After a period of moderate price increases, inflation began climbing, fueled partly by massive fiscal stimulus and ongoing supply chain disruptions. Though some measures, like the Consumer Price Index, CPI, have shown deceleration from earlier peaks, the overall rate remains higher than the Fed's traditional comfort zone of around 2%. Meanwhile, the labor market, though touted as robust based on low unemployment figures, does not necessarily deliver strong wage growth. Many workers find that pay raises fail to keep pace with elevated prices for housing, energy, and basic necessities. A significant share of employees effectively earn less in real terms than they did several years ago. Enter the new tariffs. If Americans face price jumps on imported goods, the inflationary impact could ripple through various sectors. Even if these increases are labeled temporary, they could alter consumer psychology, fueling concerns that the dollar will not stretch as far. Under normal circumstances, when inflation rises, the Fed would tighten monetary policy, raising interest rates to curb spending and borrowing. But the tricky part now is that the economy teeters on the brink of contraction. By continuing to raise rates when GDP growth hovers around zero, the Fed risks tipping the economy into a recession. That is especially delicate given widespread signals of shrinking consumer savings and ballooning credit card balances. If, on the other hand, the Fed decides to pivot dovishly, easing rates or resuming asset purchases to stimulate demand, it may inadvertently fan the flames of inflation. Recall that the government's fiscal position, marked by a large deficit and substantial debt, could amplify inflation if spending remains high and monetary policy becomes more accommodating. The precarious balance demands surgical precision. Jerome Powell, the Fed chairman, has indicated the institution will remain data-dependent, but that data is sending mixed messages. Some officials believe the real danger is that growth collapses, while others warn that inflation is not yet subdued enough to risk flooding the economy with easy money again. All this uncertainty hampers corporate decision-making and unsettles the bond market. Traders in Treasury securities appear at times more concerned about recession than inflation, as evidenced by flattening or inverting yield curves. Inversions historically predict downturns. Investors buy longer-dated bonds, driving those yields lower because they expect the Fed will eventually cut rates to combat a slowdown. This cyclical interplay complicates the Fed's choices further, creating feedback loops that can push the central bank to act more decisively or wait too long. Any misstep could reverberate through credit markets, equity valuations, and foreign exchange rates. For instance, an aggressive Fed rate hike cycle might boost the dollar, hurting exports and exacerbating trade tensions. Meanwhile, a dovish pivot could alarm bondholders worried about persistent inflation, raising longer-term interest costs for businesses and consumers. Thus, the Federal Reserve finds itself front and center, grappling with the hardest question in macroeconomics: which evil is worse, lingering inflation or a spiraling downturn? This complexity is magnified by the new reciprocal tariff policy, which many see as an unpredictable wild card. Before exploring what this all means for individual investors, let's outline how these pressures interplay on Wall Street and Main Street, from interest rate shifts to commodity prices. In the midst of these intertwined forces, shaky consumer confidence, potential inflation spikes from tariffs, and a cautious Federal Reserve, Wall Street has been responding with a mix of anxiety and opportunism. Equity markets, famously sensitive to signs of an impending slowdown, have witnessed increased volatility. Investors often rotate funds in and out of different sectors, seeking safety when risk aversion dominates. For instance, shares of consumer discretionary companies, like retailers, can plummet if the market believes spending will collapse. Conversely, if investors believe certain domestic manufacturers will benefit from protective tariffs, those stocks might see a short-lived bump. Bond markets provide a clearer window into collective sentiment. A hallmark of caution has been the decline in long-term Treasury yields, a phenomenon typically associated with forecasts of weaker economic growth. When bond buyers anticipate recession or deflationary forces, they flock to the relative security of government bonds, thus driving yields downward. Over the past few weeks, persistent demand for Treasuries indicates many market participants are more concerned about a slump than an uncontrolled spike in inflation. However, that equilibrium could shift rapidly if tariff-induced price hikes become significant. Any sign that inflation is accelerating beyond the Fed's tolerance could send bond yields higher in a hurry, pressuring equities and pushing up borrowing costs across the board. Commodity markets, too, cannot escape the reverberations. If the reciprocal tariff plan hampers international trade flows, industrial commodities could experience sudden price swings. Metals like steel or aluminum might see abnormal divergences in regional prices, depending on where import duties land. Agricultural commodities could rally or slump based on which export markets remain accessible. Meanwhile, gold, often considered a hedge against both inflation and political uncertainty, might attract inflows if investors sense the Fed is powerless to manage these crosscurrents effectively. Over the past year, gold has repeatedly tested historical highs, buoyed by a murky outlook for currency stability and the prospect of central banks continuing to add it to their reserves. Yet the real battleground remains the consumer. No matter how sophisticated the financial instruments become, or how swiftly hedge funds reposition, the overarching question is whether households will keep spending. If average families feel too strained, entire supply chains, from electronics in Asia to clothing in Latin America, could witness shrinking U.S. orders. In the best-case scenario, the administration's reciprocal tariffs spur a renaissance in American manufacturing. Factories that had moved abroad might return, lured by the promise of fewer foreign competitors. Wages could rise if domestic output ramps up. But such transformations usually require years of supply chain realignment, workforce retraining, and capital investment. There is no guarantee that, in the interim, the average consumer will see immediate benefits or lower prices. Consider the scenario where new tariffs bite hard. If a major importer of consumer electronics passes along higher costs to retail shoppers, the jump in sticker price could depress unit sales. That slump, if multiplied across numerous categories, from gadgets to apparel, reduces overall consumption and can tip borderline households into further debt or even default. The feedback loop is vicious as defaults climb. Banks tighten lending, reducing consumer credit availability, which then further restricts spending. The U.S. economy's heavy reliance on consumption means that a bruised consumer can spark a pronounced downturn. Against this precarious canvas, analysts note that clarity from the Federal Reserve is more vital than ever. If the Fed signals it will not overreact to temporary inflation bumps from tariffs, markets might relax. However, if Powell hints that the central bank will clamp down preemptively, investors could brace for a harsher tightening cycle, accelerating the flight to safe assets. In short, the interplay between tariff-induced inflationary pressure, the potential for a consumer pullback, and the Fed's balancing act forms the triad shaping near-term market behavior. Next, we will delve into practical strategies for individual investors. Mindful that balancing risk and reward requires a disciplined and adaptive approach. For everyday investors, The swirling uncertainties surrounding economic indicators, trade policies, and the Federal Reserve's stance can feel overwhelming. However, times of turmoil often present opportunities for growth as well as risks. One of the first principles in volatile markets is to maintain perspective. Emotional reactions, whether panic selling or fear-driven hoarding of cash, rarely produce optimal outcomes. Instead, it's wise to cultivate a balanced view. Accept that near-term headlines might be grim, but also recognize that well-structured, long-term strategies can thrive despite short-term turbulence. Begin by revisiting your personal financial foundation. Before making bold plays in stocks or commodities, ensure you have a sufficient emergency fund, enough to cover 3 to 6 months of living expenses. Economic slowdowns, especially those fueled by consumer retrenchment, can lead to layoffs or reduced hours. Adequate savings act as a safety buffer, preventing you from liquidating investments prematurely at inopportune moments. Next, consider the role of debt in your financial picture. With interest rates potentially rising if the Fed tightens policy to combat tariff-driven inflation, carrying high-interest credit card balances becomes a heavier burden. Paying down revolving debt not only reduces monthly expenses, but also frees up mental and financial space to explore investment possibilities. Once you've solidified your personal balance sheet, approach the markets with caution. Overly aggressive moves based on speculation that tariffs will usher in a manufacturing revival could backfire if consumer demand collapses first. Conversely, an overly defensive posture, such as converting your entire portfolio to cash, could lock in losses and cause you to miss out on potential gains should the economy defy expectations and rebound. Thus, diversification remains key. Holding a mix of stocks, bonds, and possibly a small allocation in alternative assets like gold can help cushion against unexpected shocks. Exchange-traded funds, ETFs, or low-cost index funds that track broad benchmarks may be especially useful as they dilute company-specific risk. When thinking about equities, look for businesses with robust balance sheets and the ability to maintain margins even if import costs rise. Firms that have pricing power, meaning they can pass cost increases on to consumers, are better positioned to weather a tariff-induced environment. Additionally, companies less reliant on discretionary spending may fare better if consumers tighten their belts. Defensive sectors, such as consumer staples, healthcare, and utilities, traditionally exhibit resilience in downturns. Still, no investment is immune if a recession truly takes hold. Monitor corporate earnings reports for clues on whether management teams are successfully mitigating supply chain disruptions and potential tariff impacts. Bond investments also warrant careful consideration. If recession risks continue mounting, higher-rated government or corporate bonds might thrive, as interest rates could eventually trend downward if the Fed feels compelled to stimulate growth. However, if inflation proves stubborn and the Fed tightens further, longer-dated bonds could suffer price declines. Shorter duration bonds may offer less yield but protect better against rising rates. Always weigh credit quality and maturity lengths in accordance with your risk tolerance. Lastly, keep an eye on global developments. Other countries may respond to U.S. tariffs by erecting barriers of their own, thus impacting multinational corporations and possibly creating currency fluctuations. International diversification might buffer some of these region-specific shocks, although it introduces its own set of complexities. Regularly revisit your strategy as conditions evolve. While it's important to remain consistent, being too rigid can be costly when macroeconomic factors change quickly. Above all, remember that no single approach fits everyone's profile. A retiree's portfolio should look different from that of a young professional with decades left to invest. Align your actions with your financial goals, time horizon, and appetite for volatility. Therein lies the essence of strategic investing, calibrating carefully, maintaining discipline, and adjusting your sails without losing sight of the broader journey. Next, we'll consolidate the key lessons gleaned from this intricate landscape. As we move toward a broader summary, let's reflect on the central themes shaping this economic juncture. First, the weakening position of the U.S. consumer suggests a natural brake on GDP growth. People cannot keep spending if real incomes stagnate and savings run dry, especially when confronted by mounting debt. This dynamic raises red flags, as consumer expenditures comprise a substantial portion of U.S. economic activity. Second, President Trump's reciprocal tariff policy arrives at a moment of heightened vulnerability, potentially propelling import prices upward just when Americans can least absorb extra costs. Although framed as a patriotic move to restore domestic manufacturing, the near-term reality might see strained households shouldering higher prices before any meaningful industrial renaissance can emerge. Third, the Federal Reserve stands at a crossroads. Policymakers must weigh the inflationary potential of tariffs against the looming possibility of recession. It's a balancing act with no easy resolution. If the Fed tightens monetary policy prematurely, it could deepen the downturn. If it loosens it too generously, inflation may surge anew, complicating an already tense environment. This tension permeates financial markets, manifesting as choppy trading sessions in equities, seesawing bond yields, and renewed investor interest in safe havens like gold. The interplay of these forces underscores the precarious nature of the current economic phase, where a single miscalculation can lead to broad repercussions. A fourth and overarching theme is uncertainty. Trade conflicts by nature are unpredictable. Countries targeted by tariffs often retaliate, generating a spiral of protective measures and undercutting the stability that businesses need to plan production and investment. Multinational corporations, for example, may hesitate to build new facilities or ramp up hiring if they cannot gauge the long-term environment for cross-border commerce. Furthermore, the U.S. government's budget deficits, already ballooning, place additional strain on fiscal policy. Even if tariff revenues materialize, they may not fill the gap created by potential tax cuts or offset the spending necessary to manage an economic downturn. Throughout these developments, investors might feel caught in the crossfire. However, one of the strongest takeaways is the value of adaptability. Market participants can embrace a mindset that remains alert to shifting data and flexible in strategy. A pragmatic approach acknowledges that today's tariff policy might eventually change, either through new bilateral trade deals or modifications by subsequent administrations. Meanwhile, concerns about consumer insolvency or mounting job losses could spur unexpected stimulus measures, from infrastructure spending to new direct support for households. That's why seasoned investors avoid dogmatic stances, preparing for various outcomes through scenario planning. The potential silver lining is that periods of volatility can reveal bargains in specific market segments. If the broader sentiment is negative, fundamentally sound companies might see temporary sell-offs, offering attractive entry points. Contrarian strategies can sometimes flourish when headlines are bleak, provided investors execute proper due diligence and maintain a sufficient time horizon. Additionally, government policies rarely remain static. If enough pressure builds in the business community, the White House could soften its trade stance, or Congress might introduce legislation to mitigate the impact on consumers. In such a fluid backdrop, clarity often emerges for the patient. Ultimately, the interplay of consumer fragility, trade upheavals, and monetary policy tensions shapes the contours of the current macroeconomic landscape. While challenges abound, recessionary warning signs, inflation risks, and global trade frictions, opportunities also lurk for those who keep a level head. By staying informed, calibrating their portfolios responsibly, and remembering that markets move in cycles, individual investors can navigate even the most tumultuous period with a measure of confidence. In the concluding paragraph, we'll tie these insights together, reiterating how prudent management of emotions and capital can yield success amid economic headwinds. Gathering all these threads into a coherent picture, the message becomes clear. the U.S. economy sits at a precarious juncture, where weakening consumer fundamentals coincide with an ambitious new trade policy and a Federal Reserve that must walk on eggshells. As households exhaust savings and face rising debt, the usual engine of economic expansion, the consumer, may sputter. In tandem, President Trump's reciprocal tariff initiative, while theoretically striving to bolster domestic industry, risks undercutting consumption further by raising prices on a broad array of goods. Placed in this context, the Fed's goal of supporting sustainable growth without letting inflation flare becomes all the more complicated. However, complexity need not spell doom. Awareness of these dynamics is the first step toward making better financial and personal decisions. By recognizing that GDP forecasts are dipping, one can avoid complacency in the face of potential recession risks. By understanding that tariffs often function as taxes on imports, it's easier to see why consumer prices might climb. Armed with this insight, households can adjust budgets, reduce unnecessary liabilities, and build rainy day funds. Likewise, investors can shift strategies accordingly, diversifying across asset classes, setting aside emergency cash, and avoiding excessive leverage. Market volatility, while daunting, also provides openings to accumulate positions in well-managed companies trading at attractive valuations. All the while, the Federal Reserve's path remains a focal point of market speculation. If officials adopt a wait-and-see attitude, markets may gyrate each time new economic data or tariff announcements challenge existing assumptions. Should the Fed pivot decisively, either cutting rates to stave off recession or hiking them to quell inflation, markets could lurch in response. That unpredictability intensifies the importance of keeping tabs on both official statements and the evolving macro backdrop. Observing shifts in consumer credit usage, corporate earnings guidance, and global trade flows can offer early indicators of which direction the scales tip. Thus, the essential takeaways revolve around a mix of caution and opportunism. Recession signals mean vigilance is warranted, but downturns are not a guarantee. Tariffs might impose near-term costs on households, but they could catalyze certain domestic industries in the longer run. Monetary policy might look boxed in, yet the Fed still wields potent tools, lowering rates, creating special lending facilities, or, in more extreme scenarios, employing unconventional measures. With so many moving parts, flexibility becomes a virtue for businesses and private investors alike. Plans that seemed wise last year may require adjustment, especially if the tariff policy evolves or consumer confidence erodes quicker than expected. As you navigate these crosscurrents, maintain a disciplined approach to decision-making. Avoid chasing sensational headlines or succumbing to panic-driven trades. Focus instead on fundamental analysis, risk management, and the long game. Stay aware that cyclical downturns come and go, and that wise, patient investing often rewards those who look beyond immediate gloom. Equally important is keeping your personal financial foundation strong. If job security becomes uncertain, have backup plans. If the stock market plummets, remember that recoveries can happen, particularly for investors who resist the urge to sell in despair. This interplay of rational optimism, sober planning, and adaptability forms the essence of enduring success in an unpredictable economic climate. In closing, whether the months ahead bring a mild slowdown, a sharper recession, or a surprising rebound, the fundamental principles remain. Keep informed, stay calm, and adjust to new evidence. The U.S. economy may be sending SOS signals, but markets have weathered numerous storms before. By anchoring yourself in robust financial practices and measured strategies, you can traverse the turbulence with greater resilience. Thank you for joining this journey into the complexities of American economic life. Continue to evaluate fresh data, refine your perspectives, and share insights with fellow market participants. Together, we can transform uncertainty into informed decision-making and, in the process, cultivate financial well-being even in the face of formidable headwinds.